We'll start with a very fascinating aspect of an ETF. Liquid BeES is something which is like a lot of people have a lot of doubts about it. So can you explain कि ETF क्या होता है?
A ETF is nothing but an exchange traded fund. It allows an investor to take exposure to a simple investment in a single unit.
There are two options in liquid BeES. One is dividend and one is growth. Can you explain both of them?
Liquid BeES per se is IDCW, income distribution cum withdrawal option. The incremental interest earned by the investor is in form of units. What happens on the growth option is,
where do you see the growth of liquid BeES in India? Is there a possibility that it can replace traditional investments?
if we see in terms of Demat, 2019 or 20, there was around 4 crores of Demat accounts and now they are 20 crores. In terms of future, there's a lot of potential to grow. We are still at a very nascent stage in the market.
Liquid BeES usually reflect Nifty one-day rate index, but we see a tracking error in both of them. How do you manage that, and usually how much is that tracking error like? हेलो एंड वेलकम टू धन्स पॉडकास्ट। आज हम बात करेंगे लिक्विड बीस के बारे में और उसके लिए हमारे साथ है हिमांग जी फ्रॉम निपॉन म्यूचुअल फंड। हिमांग हैज ओवर 15 years of experience in this industry. He has worked in NSE, S&P, and now he is working at Nippon Mutual Fund. Himang is the national lead of product at Nippon Mutual Fund. Hello Himang, welcome to Dhan.
Thank you.
So how has been your experience in Nippon over the past years and in the industry also?
So thank you, Dan, for having me here. So Nippon, I have been there since March 2022. It's more than 3 years now. So I was back then for as an index developer, and now I am with Nippon leading the passive product business. So it is great to see the indices that we have worked on in the past having a front end now. So the experience has been tremendously good, a very good learning curve. Uh, as you know, most of the funds that are being launched right now, so out of 10 new NFOs, almost 6 to 7 are passive. So it has been a great, learning, and it has been a run, I would say. So yeah, overall a great learning experience, good time, good modes of action right now, lots to see in future. So I am having a very positive outlook, especially for passive funds in future.
I think it's an amazing journey for you, since there might be some indices which you made initially and now like you are managing them passively via your product. So it sounds very fascinating in general. We'll start with a very fascinating aspect of an ETF known as liquid BeES. A lot of people like they know about gold BeES, which is very common, other commodities also. But liquid BeES is something which is like a lot of people have a lot of doubts about it. So we'll first start with what is ETF. In very simple terms, can you explain that कि ETF क्या होता है?
Great question to start with, actually. So a ETF is nothing but an exchange traded fund, which is an open-ended mutual fund scheme, right? So what an ETF does is, it is a passively managed scheme where it tracks the underlying index, right? So underlying index can be anything. It can be an equity index like a Nifty 50 or SenSex. It can be a commodity like a gold or silver, or it can be debt scheme, right? Like the liquid ETF that we are going to talk about is based on the Nifty 1D rate index, right? So it allows an investor to take exposure across various asset classes, that is equity, debt, commodities, through a simple investment in a single unit. So the underlying would have multiple stocks in case of equity, while one would get an exposure to those stocks with a single unit. So that is how an ETF works. The main feature of it is very simple. It is transparent. The methodology is already in place in public domain. One can go and have a look at the methodology and understand how the underlying product works. It is transparent in terms of, for example, when you want to see a Nifty BeES or Nifty ETF or a Sensex ETF, one can just have look at the market, how it is, trading at, what levels it is, and one would gauge an idea of what my underlying would be. Unlike an active fund, where the fund manager takes a call of what stocks to add and what stocks to delete from the his portfolio, here it is completely hands-off approach. All the stocks which are part of the index will be replicated in the underlying fund, that is the ETF. That is how it works, right? And of course, for the topic of the day, we will put a highlight on the liquidity.
One thing I think काफी लोगों को doubt है कि one day rate क्या होता है? Can you explain that? कि काफी सारे ETF के आगे लिखा रहता है one day rate, तो उसको explain कर दीजिए.
Sure. So what liquid ETFs does primarily is that it invests in overnight market, which is basically having a maturity of 1 day, hence the name one day. So this overnight market is basically TREPS. It is a tri-party repo, right? So what is a tri-party repo? Just to explain a bit more briefly. So here there will be a borrower, that is one party. There will be a lender, this is the second party, and third party is basically the CCIL, right? The Clearing Corporation of India Limited, right? So in TREPS, it has a collateral which is backed by government securities, right? Like repo or reverse repo, right? T-bills, etc. Uh, it has an overnight, overnight rate. So that's why one day. So that is how that 1D has come into picture. So liquid ETFs, like I said, would invest in these underlying instruments, right? And returns that are generated, or I would say interest that is generated on daily basis, on accrual basis, gets reflected in the NAV of the ETF. So now coming to the second point is just explaining a bit broadly. These days, liquid ETFs come in two forms. They are basis growth and dividend. So in the most traditional one is the dividend one. So what happens there is every time the interest gets accrued, right, it is invested in the ETF, right, in form of units. So an investor typically would see that credit in form of units, right? For a growth, the NAV will keep on incrementally increasing or compounding, and the returns that you see are compounded on daily basis. So you will see the growth of your returns in NAV. In terms of dividend, you will see the growth in terms of units. That is the basic difference.
Okay, so there's like you said, okay, there's a collateral behind it. So it is regulated by RBI or SEBI.
Yes. So CCIL is the counterparty to it,
Hmm.
right? Liquid BeES, basically liquid ETFs are a very safe instrument to invest in. There are a couple of reasons. First of all, like I said, it is backed by government securities, right? T-bills, G-Secs, etc. Right. Second is the duration for which, like I said, is only one day. So if I give a very different example, right? Within debt, uh, if you have a longer maturity debt, so any changes or RBI policy that happens in the underlying repo rate, right, it will have an impact on the long-term bond, right? If the rates go down, right, the prices will increase, and vice versa, right? The risk of this, the volatility becomes very minimal because the duration is only one day. Correct? So that way, it is a very safe instrument. Third point is that because it is having a collateral by CCIL, that's Clearing Corporation of India Limited, guarantees the settlement, clearing, and risk part of it. So at any point in time, between a borrower and seller, right, who are anonymous to each other, when they do trade in TREPS, underlying TREPS, the settlement guarantee is given by CCIL. Hence, the default is almost negligible or nil, right? And as you know, all these underlying securities are sovereign. So again, the risk is very, very low, right? So interest rate risk and the credit risk both are very low in these instruments. So it's very safe for an investor to think to have an investment there and start earning. So just to also add, liquid BeES per se, as they invest in these instruments, typically would get a returns of around between 4 to 5% or sometimes 6%. Again, as it is dependent on the repo rate, currently as of now, the repo is unchanged at 5.5%. So one can expect a returns around that, right? Instead of having that placed idle. So why is it used? It is used by investors who can invest in liquid BeES and earn something, right? Like I said, 5.5% or 5 to 6% in these instruments instead of keeping it idle in their margin account. So that is how the working would be.
So we can call this more like a flexible FD, like liquid or flexible FD, where like you can take out the money instantly and there's very less risk also.
So yes, in a way, yes. So it gives you the flexibility there. But unlike FD, where in case if you withdraw prematurely, there would be a penalty levied, right?
Yeah.
Plus, it is standing in an ecosystem which is outside the trading ecosystem. It is standing in a bank's account, right? Every time you try to say cut off your FD before it matures, you will have a penalty. Plus, your funds will be coming there. Then it will be cumbersome from handling those funds from FD or your saving bank account into your trading account, right? What happens here is that, for example, I'll give you a scenario of how it actually works, right? We'll go to the exact process. So let's say you are an investor or a trader who's active in the market, right? So what will you need is you will go to the bank account and take your funds, put it as you place it as cash, right? And basis that the broker allowed you to make a purchase, right? Similarly, when you sell, your on T+1, your stocks will be sold, and you will get cash which will be lying in your margin account, right, on the broker's account, right? Now, idle cash lying there is actually no money. You are not earning anything. It is zero, correct? Now, as I said, liquid BeES or liquid ETFs are very safe instruments. What one can instead do is, so in a normal scenario, one would sell stocks, right? T+1, you will get cash. Lying idle, no returns. In this scenario, when you sell stocks, simultaneously at the same time, you can purchase liquid ETFs. What will happen is, say for example, you sold an amount of 1 lakh rupees worth of share. You can place an order to buy 1 lakh worth of liquid ETFs. On T+1, it will square off. The stocks that were lying in your demat account will be debited and liquid ETFs will be credited. As soon as they are credited, it starts earning the returns that I was talking about earlier from day one. Unless next, when you want to make a opportunity or you see an opportunity to purchase a new stock or a new new trade, right? Till then you will earn your interest. Let's say you see an opportunity tomorrow or day after, or after a couple of days. So in case of a normal case, the cash will be lying idle. Here what you can do is, let's say today is we are sitting on a Friday, right? And let's say you have sold it, right? T+1, you will get something on Monday, right? Next opportunity you see only 4 5 days or 10 days later, right? And on that day, during that phase, you will start earning interest. On that day of trade, when you want to do it, you can directly sell the liquid ETFs and simultaneously buy the stocks that you desire. Okay. When you sell this, so you get a margin of around 95%, 90 to 95%, typically depending on the broker. There's a 5% haircut on liquid ETFs. So you get a very good amount of margin to make your next purchase. And again, it can happen simultaneously. At the same time, you sell your liquid ETFs and you buy your desired stock, right? So there's no way the cash remains idle or it is out of the system. It becomes a very efficient tool to keep your money within the trading ecosystem while earning on it, right? So that is the main advantage here. So at the buy and sell, both places legs, you can use liquid ETF as your tool. It will help you earn some interest, and thirdly, it is within the ecosystem, making it very easy for you. Unlike, again, coming back to saving accounts or FD, you will be out of the system. It is cumbersome to draw money from your margin account to, let's say, even if you say that you want to put in your savings account, you might marginally earn. So here typically it will be 4 to 5%, 5.5% returns. Saving account, typically most banks would offer you 2 to 3% returns, right? If you keep it on FD, again you will earn a higher interest, but then you have a penalty on getting out. And active traders generally would want something which is very fast, liquid, very easy to use. So that operational process of transferring money from a saving bank account or a FD to a margin account and then using it is cumbersome. For active daily trader, if they don't want that hassle, they can just park their money in liquid. It is safe, right? Can start earning higher interest than a savings account, while making it easy for them to play between the trades. That is how it would be.
I think people who have been trading derivatives also, for them also it's a very good option, since 5% haircut is pretty good. Like, yeah. Also, what's the settlement time? Is it like T+1 or like same day?
Okay. So I'll answer both the questions. So yes, you're perfectly right on that. Those who are using it for derivatives, right? They can keep it or pledge it as a collateral, right? And they will, like you said, will get with a 5% haircut or 95% of margin, right? So they can use it for the derivative view whenever they have, right? While that happens, the interesting part and the most crucial part is this: you are pledging your ETFs, right, for your derivatives, 95%. While that happens and you are playing on your derivative view, this will still keep earning, the one that I said, right, 5 to 6%. It will still keep earning. So in a way, it becomes a cushion to you for a derivatives trader to earn your. Let's say you are taking a view for a month on month. So typically a 5% would bring down to certain percentage every month, and you are doing this every month on month basis, right? will keep earning on a annual basis around 5 to 6% while you are taking that trade.
Yeah.
So your risk efficiency in a way becomes good, right? You have some cushion here. Second advantage for derivatives is, so derivatives always needs either you put a cash, right? So that cash, again, similarly to your normal equity cash trading, it will remain idle. You will have to pledge that much cash, earning nothing. Second is, if you keep your existing mutual funds, if you keep your stocks, typically for equity stocks, you would get a pledge, or there would be a haircut of anything between 20 to 50%.
Yeah.
Correct. Also, what will happen is there will be a mark to market risk. If your equity stocks, let's say due to any black swan event or unseen circumstances, falls down, you might get a margin call, right? And your value will devalue. What happens here is, as I said, is government backed securities underlying, and you have a 95% margin. There is no way of going down in a way in liquid ETFs, correct? So that risk of having a margin call because of loss in value will not happen. So that is why it is so called no mark to market risk in
Okay.
liquid ETFs. So that is one of the advantages while using it for derivative trading. So that is how it works. The second question that you asked was basis, how is the trading settlement, right? So this will be traded and settled basically if you're doing your trade today, you're buying or selling your liquid ETF today, on T+1 basis, we'll see in your account,
Okay.
or it will go out of account. So it is T+1 settlement.
I think so. The good part is कि say people who are trading with a good amount of money, this 5 or 5.5% can counter their slippage or whatever it's happening. So it's good for them. One question which comes to my mind is कि how liquid ETF is different from say a Flexi Cap Fund. Pledging a Flexi Cap Fund versus liquid ETF, how can liquid be better? Is there any difference?
See, FlexiCap would not be the ideal comparison for liquid funds. FlexiCap would invest into any segment of the market, large cap, mid cap, and small cap. This is the view of the fund manager. He will be overweight on certain segments or underweight on certain segments. This is how the market movement is happening, right? Typically, because it is the underlying is pure equity, right? The margins will be pretty lower, obviously lower than a liquid ETF, where because the underlying is just straps, basis 1 day overnight rate, right? Having a margin of 95, there the margin will be pretty low, right? So pledging that in a way to take a call on your view on derivatives, or making a trade, I don't think should be very ideal. Maybe the better comparison might be a liquid fund per se, right, where you can do that. But again, any mutual fund per se, other than an ETF, right, is out of the gamut of the ecosystem of trading. For a trader, it will be most easier to have an ETF in place, which is part of the EQ ecosystem, where they can just buy and sell, right? For a mutual fund, it is outside the gamut. First of all, it will need to be in demat. If it is not in demat, you will have to convert that mutual fund into demat form. If it
Yeah.
is not there, that is a cumbersome process. Again, you will have to do that operational thing, right? If it is already in demat, still you will have to put a pledge on it, right? And when you want to take out the pledge, you will again, here it is just a click of a button. You just need to buy your liquid against your sell. Similarly, you want just a click of a button, you need to sell liquid and buy the next position. Meanwhile, also when you keep a block, let's say for derivative margin, you want to just keep it as a pledge, you can buy a good quantum of liquid. Your trade, how much you want as a margin. In a way, you can just park your idle money there in liquid and do the trade, right? So you would not need to go out of that ecosystem at all. So maybe any mutual fund per se, liquid or flexi, the ease of ETF is much more and very high than going out of that gamut and pledging a mutual fund portfolio.
So Nippon was the first one to start liquid BeES in 2003. What was the vision back then? What motivated you to start this in India? Because that time there was no awareness also. And how was the response that time versus how are people investing in liquid BeES right now? How has been the liquidity over the past few years? Yeah.
Sure. So obviously, I was not part of that game back then. So this liquid BeES was started by a company called Benchmark AMC, which later was taken over by Goldman Sachs, then by Reliance, and which is now Nippon, right? So it has a long legacy. but the product remains with in the same line, and we have that product today. I think back then in 2003, when it was more like a necessity, right? It was an innovation for a necessity. Uh, that time the digitization, I think, might be very minimal, right? What used to happen, so we understood the play of how it is accessible and useful for trades, right? Back in the day, what would happen is, if you remember maybe your father's time, or those days, if you want to fund your trade, you will write a check to the broker.
Yeah.
Right? You will deposit that check. It will take a day or so. If you are out of that same day range after 11 p.m. or something, 11 a.m. or something with the bank, it will take additional day. Right? If it's a weekend, it will further take a day, and you will not earn anything by then. Right? Similarly, if it's an outstation check, the time will be further more. Similarly, for a broker also, when he does a margin call in case, right, of emergency, uh, there's a risk that he will have to wait when the check passes, clears or not, if the fund is available at the investor's account. All those cumbersome things used to happen, right? It used to take time, had a lot of operational inefficiencies. Even for a broker, understand there will be n number of users or his clients. Having a complete back office put in place for writing a check, sending outstation, posting them, depositing those checks, will require manpower, trading hours, and a lot of inefficiencies. I think all these inefficiencies put together may have come across and came as an innovative thought, that why not come up with liquid ETF, liquid BeES per se, right? Where the usability is very simple. There are few things here. When you have the liquid ETF, like I mentioned earlier, liquid BeES. So once it is safe for the investor also, right, and the broker also. How? For the investor, he has invested in it. He knows that he's earning something, right? He has pledged it. It is backed by government securities, very low credit risk, very low duration risk, right? For a broker, how? Because it is already pledged, right? So if in case there is a margin call, he does not have to go back. If there's a default in giving the margin call by the investor, the broker would not need to go back and wait for the fund to come in, the check to clear. He will just use that liquid ETFs, maybe with the consent, and the investor also might be okay to use that liquid ETF directly for the margin call.
Yeah.
Right? So the risk terms becomes very low. Investment terms for the investor becomes very high, plays as a cushion. So overall, I think that might be the idea with which it came, right? Over the years, to answer your next question, how has it run up? Of course, as soon slow and steadily awareness came into being, and the volumes have gone up. I would say the average yearly volume as of today is more than 300 crores for liquid BeES per se. We are one of the largest, and we command a volume share of almost 51% across all liquid ETFs in the industry. The ETF also is one of the largest in terms of AUM, almost garnering around 49-45% odd AUM. So it has taken its popularity up, and I'm pretty sure the volumes will still go up with support of brokers like you, who are making this awareness program of how this can be used and how it can be helpful for regular investors for parking their money.
So Hemang, my next question is, what is your market share in terms of volume in liquid BeES, and how is liquidity important in this ETF?
So to answer your first question, so we are having a volume of around 300 crores plus on an average daily volume for past 1 year, which is almost 51% of the entire market of all 18 liquid ETFs that are there in the market, which is pretty high, right? And the liquidity per se becomes very critical here for liquid ETFs, because one generally for liquid BeES per se, there are two-way quotes given, right? So the NAV is stuck at 1000. The two-way quotes are at 999.9, and the above is 1000.01. So it is a very tight spread, right? Higher liquidity becomes very important, because then one can buy and sell basis within these quotes. The liquidity is pretty low, right? The price quotes can go anywhere, because finally it is traded on the market like any other stock, and then the demand and supply game would come into picture. A very high liquidity will ensure that you are within that bracket of 999.99 or 1000.01, and then you get that liquidity very well to execute your trade.
So you just told ki NAV is fixed at 1000. So how is that structure decided? And what's the logic behind it?
Great question. So, in fact, good you brought this question up. It is very confusing for first-time investors of liquid BeES to see that NAV is fixed at 1,000. It has been around, like we said, more than 2 decades, and NAV has not moved. So, I'll tell you what the structure is, right? So, like I explained earlier, liquid BeES invest in underlying TREPs, which is backed by government securities, right? Every day, it would earn some amount of interest, right? This interest per se uh, is again reinvested in the scheme, but given out to investors in form of dividend units.
Yeah.
So the endeavor of the fund since the beginning, if you see the NAV on day-to-day basis since the beginning is 1,000. The endeavor is to treat it like a cash, right? It is very easy to understand it is 1,000. What you see in your books as an investor is the incremental units that gets increased on your interest that you earn on underlying, right? So that is how the functionality is. Now, second comes to when does this happen? So the units, in a way, gets accrued. The interest gets accrued everyday basis, right? But gets credited on a periodic basis, like a weekly basis. For example, for Nippon, we have a weekly credit of those units. So the interest that you earn will be reflected in units, right? Thereby keeping the NAV constant at 1,000, right? So that is how the functionality is. For us, it is 1,000. For some other ETF, it might be 100. So that is how a dividend option of the liquid ETF works.
There are two options in liquid BeES. One is dividend and one is growth. Dividend one we have seen from a long time, like it's been there in the markets. And recently we have seen the growth option also. So can you explain both of them in detail?
Thanks for the question. Like you explained earlier, so liquid BeES per se is there since more than 2 decades, right? As I explained earlier, the NAV is constant at 1,000. The incremental interest earned by the investor is in form of units, right? Keeping the NAV constant. The second case is the growth option. What happens on the growth option is same way it will also invest in TREPs, which is backed by government securities, while the interest that is earned on the underlying securities is reinvested into the NAV. Thereby, one can have a view of the growth in the NAV and track the returns easily. So the use cases becomes different. One place where you have a constant NAV, and the other place where the NAV will keep on increasing basis the unit. So here it is units which will see the increment. Here it is the NAV which will see the incremental compounding of returns.
मान लीजिए कि एक इन्वेस्टर है, उसको इन्वेस्ट करना है, तो which option will better suitable for him? Like how will you segregate an investor who wants to invest in, say, a growth liquid BeES or a dividend based in liquid BeES? Also, say for a longer period of time, will there be a difference in returns in growth versus dividend? Or where it will be similar only?
Great question. So here what will happen is in terms of growth and dividend option, right? These are just two options given for ease of investors. The way they want to take a call on where to go can be different. So for an investor who wants use case by use case, if one wants the ease of looking at how his investment is tracking, and he wants to track NAV for looking at how and where his investment has gone to, right, and compute his returns on day-to-day basis, he may go with the growth option. If he chooses that he wants to see the incremental units being credited in the account, he may go with the dividend option. Now, what broadly we have observed is generally it is ease of purpose in dividend option for a very active trader or a large trader, institution, treasury desk to quote the number for dividend. For example, let's say you are a very active investor, very heavy trader or a treasury or an institution who would not be bothered by the incremental NAV. It's more bothered by the ease of use. So one can just pick up a call to the broker or place an order. You know that you are around 1,000. You always know that when you want to buy, you are at 1,000.01, like I explained earlier, and you want to sell at 99.99. So it becomes very easy to just keep that in mind. Operational ease is very easy. It is very quick to think of that it is constant at 1,000. You can think it as a cash, right? And in which case you are earning some returns on it in form of units. So the use case becomes there. For investors who are wanting to see that return incremental in the NAV itself and do not want the units to be credited in their account, which are fractional, for, let's say, a regular individual investor, this would make more sense, right? Also, what we have observed is that PMS desk, right? These guys have a lot of investors, a lot of ultra HNI clients, right? It becomes difficult for them to manage each investor's returns, because then you will need to go into the statements and calculate how those dividends have actually accumulated in the returns form. So it becomes easier for them to use the growth option, right? For individual investor or retail participants, again, it is a choice, like I mentioned. If they want to see the units incremental, or whether they want to see the growth in terms of NAV, they can go for either of those options, right? So that is how the use case will be different, and it has both has their own advantages and disadvantages.
So how does the expense ratio works in this? Also, if there an exit load on like both of them or not? Is there a difference between expense ratio also?
Yes, so units, when the units are credited in dividend option, it might have a slightly higher expense ratio because operational
Yeah.
expenses there. In a growth option, it will be slightly lower because it is just reinvestment in the same gamut. So expense ratios are pretty similar as such, would be very near to each other. So in terms of exit load, there is none. So both the options have no exit loads. Even in terms of return and tracking error, both will be very similar because both are finally investing in an underlying instrument, which are TREPs, right? Here you will see the returns when you accumulate in terms of units. In growth option, you will see in terms of your NAV. So returns will be very similar. Your tracking error will be very similar. Your expense should be around each other. So that is how it will be.
Looking over the past returns, so liquid Bs usually reflect Nifty one-day rate index, but we see a tracking error in both of them. So how do you manage that? And usually, how much is that tracking error like?
Thanks for the question. So you are right. Nifty 1D rate index becomes the benchmark index for liquid Bs, right? So what the 1D rate index does is it invests in TREPs, again backed by government securities. It is overnight market, right? It tracks the underlying, right? And every day the interest that it gets accrued gets reinvested in the index. So that is the index, right? For a fund like liquid Bs or any other ETF, right? Because it has an expense ratio linked to the ETF, which will be charged to the investors, that will be the gap between the returns of the index and the returns of the fund. So broadly speaking, that will be the only tracking difference between the ETF and the index, right? Overall period, so tracking error is computed for a period of 1 year, let's say. So tracking error can be anywhere between 0.02 to 0.03, very minor, right? Because it is tracking both the products, the index and the fund are tracking the same underlying, while the fund would charge a minor expense ratio. That is the only deviation there. So it will be very close to the index.
Since it is an passive ETF, what's the role of a fund manager in this? Can you explain?
Sure. So the endeavor of the fund manager would be to track the underlying index, right? So they would again want to invest whatever funds they, let's say, accumulate today. They will be investing that in TREPs, similar to the index, which is showing their investment in the underlying TREPs, right? So in a way, the endeavor would be to track as closely as possible to the index. And this case is not only for liquid ETF, for any ETF, because it's all ETFs are passive. Let's take a very different example. This is the most simpler one, right? The liquid ETF is just tracking the TREPs. Let's take an example of Nifty 50 or Nifty Bank or SenseX, right? They are tracking securities that are underlying. Nifty 50 has 50 stocks, Sensex 30 has 30 stocks, etc.
Yeah.
So what the fund manager does there also is that without taking any call, whatever the weight of the stock is there in the index, he will try to have the similar weight of stocks in his portfolio. So what will happen is, in a way, because both have similar weights, right? It will track very closely the market movements of underlying stock at both the places, hence thereby having minimal tracking error. Of course, X of expenses, subject to
Yeah.
that. So that is how the fund manager will try to manage the ETF without
Okay.
taking any active call of taking something else. You will just mimic the underlying index and its portfolio.
We'll come to the last question. Where do you see the growth of liquid Bs in India? Is there a possibility that it can replace traditional investments like fixed deposit or other banking instruments? Where do you see the growth of it right now?
See, in a way, if we see the whole gamut in India, banking per se, as per MOSPI, 94% of individuals in India have a bank account, right? Use case at both places for the ETF and the bank is very different, right? In terms of DMATs, and this would be around, so we have seen a good growth of DMAT, right? So 2019 or 20, I know there was around 4 crores of demat accounts, and now they are 20 crores. That's gone fivefold. But again, caveat is this is not a unique demats, right? But there is a growth. We are yet to see more ground in terms of demat as awareness of financial inclusion comes in picture. So in terms of future, there's a lot of potential to grow. We are still at a very nascent stage in the market, right? In terms of passive itself, of the whole gamut, if I talk about mutual funds, passive itself is only 16% of the entire market, let alone be the ETFs, right? So there is a lot of growth pending. We have seen growth in demat accounts. We have seen inclusions coming in, but compared to banks, right, it is still not yet there. Second point is the use case, right? Liquid ETFs per se, the primary use case is to park your idle cash or money, right, for a short term, and this is most useful to an active trader or a trader, any trader, right, who's into the system of demat account, who's doing his trades, wanting to play on equity, right? While bank is generally used for quick access. You need to buy groceries, you need to have your day in day out things. So your money will be lying in your savings account. You can do something else with it, right? So the use cases are pretty different. We are yet to reach, like I said, for the demat accounts. So replicability of taking over the other is very minimal. Having said that, those who are already in demat can actually park their money, which is lying idle in savings bank account, in this format. Why? Again, like I said, one is they will earn a higher interest than the savings account. Savings account, typically most banks offer 2 to 3%. Here they will earn around 5 to 6% odd.
Yeah.
And second is they are already part of the trading account, so it will be very easy to buy and sell those liquid ETFs on the platform itself without having the cumbersome need of going back to the saving account and bringing back. So use cases are different. Growth, of course, like I said, a long way to go up. So yes, there's a lot of future in liquid ETFs. More the knowledge and awareness is given about how to use them, better will be the usability and personality of these ETFs.
I think this will simplify a lot for our users that what liquid BeES is and how they can invest in it. Can you give a summary of all the things we discussed so that it will be pretty good for our users to get a conclusion that what they should do?
Sure, sure. Why not? So great to go that way. So first is that, like I said, so liquid BeES should be looked at as to park your idle money, which is lying in your savings bank account or your margin account, right, and use it at your purpose for earning something, right? In a saving bank account, like I said, it would be earning something like a 2 to 3%. Of course, liquid BeES will giving you something higher than that. In your margin account, you earn zero. So again, park it in your liquid BeES. It will help you earn money. Second, it will be used by traders for keeping as collateral for their margins, for their future derivative view, right? It gives you 95% access to the margin with minimal 5% haircut depending on brokers. Third is a very different use case, right? So you can view it like as an asset allocation strategy, right? For example, you are already invested in ETFs. You already know what ETFs are. You are already invested in, like you said in start of the podcast, they are gold ETFs, they are silver ETFs, they are bank ETFs, they are sector ETF, broad market. You're already invested there, right? So what liquid ETF is like a cash. It is equivalent to cash. So a portion of it lying there, while giving you some 6% returns, gives you a cushion. So in a way, when you are taking a hybrid fund, what you do, a hybrid fund you take for the purpose of having equity and debt. Here, this becomes your debt component. It's giving you 6% of returns, while you can play your equity with ease. So it is giving you that leverage to take a higher risk in a way by keeping this as your cushion, right? So these are the use cases where which are predominantly accessible to investors, and these are the points one should keep in mind. Again, like I said, it is very easy to use. You just need to click a button on the buy or sell order on your platform. Obviously, most done users, I am pretty sure, is a very good UI. Can be easily done, and they can enjoy the returns of idle cash. The one last point that I would like to say is about the weekend returns, right? So what happens here? Margin money, like I said, if it is lying cash, there's no returns, right? We have seen that active traders generally love using this liquid ETF and park their money during holidays or during or during weekends or during when they feel that they are not going to take a next call. So what they can do is, let's say it's at the T+1 settlement. So weekend is coming nearby. On Thursday, let's say you bought liquid ETFs, right? liquid BeES, and you hold it. T+1, that is Friday, you will get the units in your credited into your demat account. As soon as that happens, you will start earning interest on it. On the weekend, those 2 days you will still earn. So it works 365 days. The clock keeps ticking with gaining of interest without losing anything. And Monday, if you see a position right open and you want to buy a stock, you can just sell liquid and buy the stock. Similarly, if you're for a longer holiday or a longer weekend, right, you can just park that money a day prior, have it units credited, start reaping those benefits. So this is the most important use case what we have understood from active users.
Is this why it's called overnight fund? Like,
Yes,
yeah.
that is why. Yeah.
Cool. So thank you so much, Hemang. I think today's session will clear a lot of doubts for our users regarding liquid BeES. I think there are a lot of people in India who still don't know about liquid BeES and how it can be a great instrument to park their idle cash. Thank you so much.
Thank you for having me, and thank you Dan for giving me the opportunity to talk about this fund.
My pleasure. If you guys have any doubts, please ask in the comment section and we'll answer it. Thank you so much.
Thank you.
Read all the related documents carefully before investing.